Hey guys, welcome to another episode of the greatest podcast on earth where we discuss everything CPA related. Today we're going to be talking about a special topic, a boring topic, but we're going to be covering substantiation and disclosure of tax positions. Hi, my name is Jeremias Ramos. I am going to be your teacher today as always. And remember, this is brought to you by thedailycpa.com. So let's just jump right into this lesson. So today's learning outcomes are three. One, summarize the requirements for the appropriate disclosure of a federal tax return position. Two, identify situations in which disclosure of federal tax return positions is required. And the last one, identify whether substantiation is sufficient given a specific scenario. So remember, statement of standards for tax services is going to be your overreaching guideline for this topic. So I put a link up on the website. You go to the dailycpa.com, you go to the corresponding article, and then it gives you detailed information that you need to know. But for the most part, I just took out the key things that you need to know for the exam. Don't worry about too much of the details. Just know this is going to be the information that you're going to need for the exam. So we'll just jump right into key topics that you'll know. So comply with the stated reporting and disclosure requirements imposed by the applicable taxing authority. So this is pretty obvious, right? So for the most part, you can't take a tax position that's illegal, that doesn't exist. You can't deduct things that aren't deductible. So if you're filling out a tax return, whether it be a state tax return or federal tax return, you have to make sure first you comply with the stated reporting and disclosure requirements. But what if the taxing authority has no written standard? Well, that's where the SSTS number 1 comes in, which is the Statement of Standards for Tax Services. So the first thing you have to look at is the realistic possibility of success standard. You should not recommend a tax return position, prepare or sign a tax return taking a position unless there is a good faith belief that the position has at least a realistic possibility of being sustained administratively or judicially on its merit if challenged. Basically, I know that's a mouthful, but basically, if there's no way the deduction will hold up if your client gets audited, then there's no way that it should be taken as a tax position. Secondly, you may recommend a tax position if you conclude that there is a reasonable basis, which is greater than 20% chance for the position that's going to be held up if it was audited, but you have to have at least a disclosure in place. You're basically saying this is the position we're taking, and this is the disclosure saying this is the reason why we are taking this position. And lastly, you may prepare and sign a tax return if you conclude that there is a reasonable basis for the position and appropriately disclose that position. So everything I just said is super complicated. That's how it's written in the standards. So I'm going to break it down in the most easy to understand way and show you exactly when you need to disclose, when you don't need to disclose, how reasonable it is, the percentage between will it hold up in an audit, will it not hold up in an audit. So let's just go right into it. So first, remember, if the taxing authority has standards on what should be disclosed, then you should follow those standards. If it says every tax position has to be disclosed, then you have to disclose it, right? But for the most part, if it doesn't spell out those requirements, then you follow these steps. So 1, the deduction will hold up. If a deduction you think will hold up, it has a 90% or greater probability of success if the IRS challenges it. What does that mean? No disclosure is needed unless otherwise stated. The next level of assurance should hold up, right? If you tell a client, if you deduct this, it should hold up. That means that it's 70 to 80% probability of success if the IRS challenges it. Again, there's no disclosure needed unless otherwise stated. Next one is the deduction will more likely than not hold up. So if you tell your client, hey, you can deduct these medical expenses, but, more likely than not, it's going to hold up. So essentially what he's saying is there is a greater than 50% probability of success if the IRS challenges it. Again, no disclosure is needed unless otherwise stated. Next one is a substantial authority for this deduction. So you may say, it's not a greater than 50% chance. So if you flip the coin, you probably lose. But the thing is, there's a substantial authority. There's actually stuff in the tax code, and there's methodology we used. There's a greater than 40% chance that the IRS is going to hold it up. Now, still, no disclosure is needed unless otherwise stated. Now, the next level is realistic possibility of success. Now, this is getting, further out there. That means a 1 in 3 chance. Right, you take a deduction, there's a 1 in 3 chance that the IRS is going to come back and say, this is going to hold up. But there's a 2/3 chance basically saying, it's not going to cut it. Now, the lowest standard is a reasonable basis. We're talking about the lowest standard possible, right? This is the 20% or greater chance of success if the IRS challenges. This is where you need disclosures. Everything above this, anything greater than that 20% threshold is fine. But that reasonable basis is the minimum amount required before a disclosure is needed, right? And anything below a reasonable basis, you can't have a tax position, right? Because this would just be fraudulent. So the last one is there's no way this will hold up, but the odds are you being audited are low, so we can take our chances. We can see where things goes. This is not acceptable. This is not an acceptable tax position under any circumstance, and it's just not going to hold up. So for the most part, what to know for the exam. The important stuff to know is the different levels of assurance when it comes to the probability of success if the IRS challenges a tax position. Basically, the will, should, more likely than not, has a substantial authority, a realistic possibility, reasonable basis. Those steps you need to know what the percentages are, which is the higher level of assurance, which is the lowest possible level of assurance. Know those differences. And again, this is something you probably have to memorize. Go into a little more detail. But for the most part, as long as you know that hierarchy of this one has more assurance than this one, then you should be fine. Again, this is Jeremias Ramos. Thank you for listening. Until next time, take it easy.